This week on the Bearded Banker podcast, financial fitness plus physical fitness equals mental fitness. 0% down, that's not a grant program or down payment assistance. Actual scenario, refi now, and purchasing a home in Vermont. That's the conversation I had with a client. And an update on the economy. Stay tuned. What's up, everybody? Welcome to the Bearded Banker podcast, hosted by yours truly, Daniel Valencia, team leader and senior mortgage loan officer, NMLS number 957014. On this podcast, we discuss everything mortgages, money, and mindset. If you're listening, you may not know, but you can watch the video of this podcast on YouTube. And if you're watching, if you don't know, you can listen to this podcast on your preferred podcast platform. Either way, I appreciate you for taking the time and hope you find it valuable. And if so, you can do all the things that we know the almighty algorithm loves. But for now, just sit back, relax, and enjoy the episode. Welcome back. Podcast number 16. Thank you for joining. So we're going over a couple things this week. Financial fitness plus physical fitness equals mental fitness. 0% down, that's not a grant program or down payment assistance. An actual scenario from this week with a client, refinance now or not, and then purchasing a home in Vermont. So those two things together and walking through that. And then an overall update on the economy. So starting with the financial fitness and the physical fitness stuff, shouts to Ty Y Fitness, at Ty Y Fitness. My soon-to-be brother-in-law, Tyler, who is a personal trainer, put together a personalized workout plan for me. It's a 4 to 6 week program, personalized to my schedule and my goals, and allowing me to push a little bit harder and have some goals over the next couple of months. So I wanted to thank him for that. You can follow him, go to my Instagram page, or go to Instagram, type in at TyY Fitness, or go to my followers and just search for him and he'll pop up. And yeah, physical fitness plus financial fitness equals mental fitness. I want to talk about that a little bit. So what Tyler was able to do for me was ask me what my goals were. And to be honest, my goals are pretty minimal as far as, working out, right? I just want to stay healthy. I want to get stronger, and I want to be in and out of the gym, 45 minutes to an hour, 5 days a week. That's it. So how I do it is I go in the morning. There's a gym in the building I live in, and in and out of there, like I said, half hour to an hour, depending on what I'm doing and the day. And I try to do it during the week, Monday through Friday. Now, if I miss a day, I'll make it up on the weekend, right? So 5 days and trying to hit those goals. I gave him a challenge. I said, I want to do what everyone wants. I want to bulk up, right? Put on lean muscle and cut at the same time, which is, very hard to do, as we all know, but wanted to challenge him a little bit and then gave him those parameters. And he put together a comprehensive workout plan for me, asked me a bunch of questions, even down to, obviously what equipment is in the gym, and putting together a program for me to follow. And I've been doing it for the last week, and it's been amazing. It's a split day program. So day 1 and 4 is the same thing. Day 2 and 5 is the same thing. And day 3 is like a HIIT, active rest core cardio day. So working out really well. He's going to do a special for us where he's going to give you that program for $99. Now, it's a lot of in-depth work he does: height, weight, goals, how you work out, when you want to work out, what equipment you have. He puts it all together and breaks it down on a nice spreadsheet for you. And you could even go back and forth and leave notes and go into depth with video links as far as form and different types of workouts. If you have any questions, it's been awesome. And you're getting it for 4 to 6 weeks. So if you think about that, that's, 5 workouts a week for 6 weeks. That's 30 workouts, $99. That's, $3 a workout that you're paying, which is nothing. So definitely worth it. And then when you get to the point that it's time to update it, or you feel like you're starting to plateau, or you need to, keep the body guessing and change it up again, we're going to revisit and probably change some things up at that time after the month and a half of this program. So, a huge thing, right? Physical fitness is so important. Anyone that goes to the gym or has worked out or enjoys working out, even when you don't want to go, when you go and those endorphins, start rushing through your body, you just feel better overall. So physical fitness is super important with just your overall mental fitness. And then something I push obviously is financial fitness, right? A lot of people are stressed out because of money, because of bills, because of not enough income, because of credit, because of debts, all those things. So these two pillars, right? Physical fitness and financial fitness. So physical fitness, find a trainer, reach out to Tyler or anyone. I follow a number of different people that can help. And then financial fitness, reach out to me. Or if I can't do it, I have a number of people that can help with everything from investments to retirement to tax planning to strategies. Reach out to me, and obviously I can help with some personal finance and real estate finance and overall guidance for that too. Those two things together, your physical fitness and your financial fitness, are really the keys to overall mental fitness and mental well-being, peace of mind. So just wanted to give Tyler a shout out. Wanted to emphasize the importance of staying active, staying fit. Another point is, a lot of people, not a lot of people, but it's come up over the years, asked me for, style tips, wardrobe tips, how to dress, things like that. I always say the best thing you can do to look better in clothes is get in shape, right? That's just the way clothes are made. They're meant to fit human bodies, right? And obviously there's all different types of avenues for people of different shapes, which is awesome. And we want to be inclusive. But if you want to look better in your clothes or out of your clothes, get in shape, right? So physical fitness is huge, and just what it does for you mentally sets the tone. I love going in the morning, sets the tone for the day, gets it out of the way, and gets the juices flowing. Now you're active and you've accomplished more than most people, by 8 a.m., 9 a.m., right? Something like that. So focus on that. Let us know if you have any questions. We can definitely help you out in that scenario. So piggybacking off of last week, the conversation about expanding the home search, right? So what we talked about last week was it's a tough real estate market. It's hard to find homes in highly dense areas, metropolitan areas, even, really nice suburbs outside of metropolitan cities. And the prices are high, the competition is nuts, and affordability is down. So what can you do? Well, you can start looking further out. And like I said last week, I always keep a pre-approval ready for myself and the wife. And I'm always kind of entertaining or looking at properties. So this week I actually decided, you know what? I'm going to take some of my own advice. And we went and looked at a few houses just to see kind of what's out there. Some in our local area, some, between a half hour and an hour away, which is a lot for us. But some, we don't want to turn anything down or be closed off to anything. We want to see everything. We want to get a feel for it. We want to take the drive. We want to be in the neighborhood. You kind of, real estate's a thing that you have to go see it, touch it, feel it, get a feel for the neighborhood, the area, the drive, and the house, right? The thing with real estate is when you look online at pictures, it's like looking at a profile on Tinder, right? Or Instagram. It's a highlight reel, and they make everything look really, really good. And then when you go there, when you're actually in the property, in the space, in the home, you'll see some things that either were, smaller in person as far as rooms or square footage, or the work isn't as good, or it needs a lot more work than it looked like it needed, or the condition isn't what you thought it was, or even just the area, the street, what's around that you drive by on the way there, things like that. So definitely good to get in the car and go check out some of these properties, get off of Zillow and go look at them, and always have a pre-approval ready. So, piggybacking off of that conversation, a great loan program, especially in these areas that are further out, is a USDA home loan program for primary residences in rural areas with 0% down. So the government has this program. It does have some income limits. It has some limitations. And there's a map. If you are interested in it, reach out to me. I'll give you all the details and the link to the map so you can look at the areas and see what qualifies or what falls into this USDA home area where you can get a 0% down mortgage. And what the government is trying to do is, stimulate buying in these areas to, help out the local economies, things like that, in these rural areas. So don't shy away from, again, expanding the search, especially with programs like that, especially for first-time home buyers. Now, it is for primary residences and, in those areas, but it's 0% down. Can't really beat it. And it's something that we've been pushing a lot in a lot of areas. And a lot more areas than you think might be in that rural area or fall into USDA territory. So, again, reach out and I'll send you the link and you can look to see if the area you're looking in or the area that you might be interested in, if you can get a 0% down loan, would be worth it. Rates are good because they're government, right? So it's similar to FHA. And yeah, that 0% down is awesome. There is a small, not a PMI, like a mortgage insurance, but something similar, but very, very minimal. And, no FHA mortgage insurance premium fee rolled in. So it's just a good program, and reach out to me for more details, like I said. So going into the next scenario, this is a little, in depth with kind of some details or specifics that I actually get pretty often. So I had a past client reach out, and we've actually been playing a little bit of phone tag, going back and forth with trying to get in touch. But we finally got in touch, and I'll paint the picture for you and give you a little bit of background. So 2022, this client, his wife, and the kids closed on a primary residence with an FHA loan. Now, the reason they had to get an FHA loan at the time was due to a derogatory credit event, a foreclosure that was on the borrower's credit, the client's credit, that wasn't his home. He had co-signed with a family member and it foreclosed, and he was still within that time frame of, it's called a derogatory credit waiting period, right? So if you have a foreclosure for a conventional loan, you typically have to wait, about 7 years before you can get another conventional loan. FHA, it's a little bit shorter. Short sales are different. Deed in lieu of foreclosure is different, right? Everything has a different waiting period, but this one was the long one. It was about 7 years, and we were at about 5 or 6 years at the time, but it didn't make sense to wait to, for that to come off. It just made sense to take the FHA loan to get in the home sooner rather than later, which we did. So now it's 2 years later. The 7 years has, passed, has elapsed, and he could technically get a conventional loan now. His question was, should he do that now? So there's a couple things we have to consider. One is, can he do it now? Yes, he can. The 7 years has passed. We can do an FHA refinance into a conventional loan, and all that is we pay off the FHA loan, whatever the balance is on that loan currently, with a new conventional loan with a new interest rate, new payment, everything, and he starts making that payment going forward. We could do it back to a 30-year fixed, or we can do, a 25-year or something different to match what he has left on that loan and keep it kind of similar so he's not paying for a longer time, or do a 30-year fix so he's not obligated to pay a higher payment, and then just calculate how much he would have to pay extra per month to get back to the same time frame he was on with his FHA mortgage, right? So if he had 27 years left, we could say, hey, just throw on an extra $300 a month to your payment, and you'll pay this new loan off in 27 years as well, but you're not obligated to, right? So you still have that 30-year fixed lower payment based on the 30-year term, but if you throw an extra $300 a month against the principal, you'll be right back to the 27 years, which is good because the months you can do it, you do it. The months you can't, you don't have to. You're not obligated to. And then maybe you make it up the next month. You put 600 if you couldn't do it that month because of a bill that, an unforeseen expense that popped up. So that was the initial question. Should we do it now? The second question was buying another home. So he was like, should I do the refinance now because I can do conventional and then look to get another home with another FHA loan? And his thinking was, I bought this house with FHA in my name, but my wife hasn't been on the mortgage or used an FHA loan, right? So this is the scenario that he gave me over the phone. So I said, we're going to split this up into two things. First, we're going to talk about the refinance. So does it make sense to refinance now? Not yet, right? And this is what I say to people that are in the market or considering doing anything as far as, mortgage related finance decisions. Work with someone that you can trust that'll say no, right? It's not the right time. Because as a commission based sales representative, I'm incentivized to say, yes, let's do it. Every deal, let's do it as soon as possible, right? But that's not the best advice. That's not the best move for this client right now. And why? So, yes, you can get out of FHA. Yes, you can get a conventional loan, but we do expect rates to come down again in the next 6 months to 12 months. So we don't want to do it now and jump the gun and then rates come down another point, 2 points, right? What we want to do is wait a little bit longer, wait for those rates to come down, because if we do it now, right, his idea was get out of FHA, get out of that PMI, that mortgage insurance, because now he has 20% equity, right? So he's like, I want to do it as soon as possible to get out of that. The problem is if we do it now at a conventional loan with current rates, let's say, 6.5%, something like that, he'll get rid of the mortgage insurance, which might be a couple $100 a month. But since he bought 2 years ago and his rate is 4% or lower, by getting rid of the mortgage insurance but increasing the rate, it's basically a wash, right? It's going to be, you're not going to save anything. You're going to be around the same payment just with a conventional loan at a higher rate. What makes more sense is wait until these rates drop, right? Maybe they go to in the fives, high fives, something like that. We can pay points to get it down to the low fives or even into the fours, and get rid of the PMI because of the equity. And now not only are you saving the PMI, you're saving on the actual loan, because the loan amount now is smaller than when he first got the house, right? Because he's been paying it over the last couple of years, and the rate is as close as possible to the same rate he has now. So we're knocking off principal, we're knocking off the PMI, we're getting out of FHA, now he has a conventional loan, right? So all those things in one shot, as opposed to doing 2 or 3 different refinances, which some people, some loan officers would do just to get multiple deals out of it, right? But it's not the right thing to do. It's not the best move for the client. So we're not going to suggest it just to potentially make more money, right? So that was step 1. Now, step 2, with regards to purchasing a home. Now, this client loves to go to Vermont. They love to ski and snowboard. I think it's snowboarding, but take the kids out and go to Vermont. And they are considering buying a house up there, like a second home. So his thinking was, and this is very, very common, he was thinking, my wife hasn't used her FHA loan, right? And most people think FHA is the first time home buyer loan. It's not. FHA is just a government program that most first time home buyers use, but it's not the first time home buyer loan. You can also get a conventional first time home buyer loan. So there's conventional, there's FHA. They're just programs that most first time home buyers use. So he said, can my wife use her FHA to purchase this home in Vermont? And, we still get the low down payment and all the perks that come with FHA. Now, unfortunately, that's not going to be possible. And here's why. FHA is a government program only for primary residences. Since your wife is married to you and you have an FHA property in your name, that's a marital residence. And FHA underwriters, our underwriters, in-house underwriters, are not going to allow or believe that she is going to use this new property in Vermont as a primary residence using FHA. Her marital residence is in New Jersey. They live and work in New Jersey. And she's been living there for a couple of years and been in New Jersey, virtually her whole life. So it just doesn't make sense that they're going to, leave this house and go live in Vermont as a primary residence FHA loan when they have this home already. The way they would have to do it is buy that home as a second home, a vacation property with a conventional loan, because FHA doesn't do second homes or investment properties, or they buy it as an investment property, conventional loan. So unfortunately, the down payments are higher, right? Second home is going to be 10% down for a single family. If it's an investment, 15, 20% down, somewhere in that range. But the thinking is, why can't my wife use her FHA? And again, when you're married, it's not so much about using her FHA, it's about the occupancy. And occupancy fraud with regard to mortgages is the biggest fraud that is committed, especially during the recession, right? 2008, pre-2008, People were saying they were living in these homes and buying, 3, 4, 5 properties, all as primary residences, which just by definition is not possible. Primary means one, it means the one you live in, majority of the time at least. So we get this question a lot. And the other side of that is, hypothetically, since your wife doesn't have an FHA loan or any loan on her credit, yes, she could get one FHA loan. So let's say, for example, they split up, they were separated, divorced, something happened, right? And she never was a signer on that mortgage or that property. She could use an FHA loan to go buy her own primary residence. But while they're married, the home they have is their marital residence. So just from a occupancy perspective, the underwriters are going to say, no, you have a primary residence already. This is a second home or an investment property, especially because it's all the way in Vermont. Now, if they refinance out of FHA, now they have a conventional loan. Does it in theory free up their FHA loan? Yeah, because you can only ever have one FHA loan at a time, right? So the fact that this client has an FHA loan already, let's say he wanted to move from this house to another primary residence, right? So let's say, for example, this house they bought 2 years ago, let's say it's a 2-bedroom, 1-bath house, and now they've started a family and they have, a kid or two, or, maybe one on the way, and this 2-bed, 1-bath house is no longer sufficient. They want to buy a new home, a new primary residence. Now, if they have this FHA loan, the new one, let's say it's 3-bed, 2-bath, new primary residence, that would make sense to an underwriter, right? Okay, your family's growing. This 2-bed, 1-bath no longer makes sense. You're going to buy this 3-bedroom, 2-bath, have more space, and do it as a primary residence. Sure, that makes sense. We'll do that. But you already have an FHA loan on your credit. You can't have 2 FHA loans. So the new one would either have to be conventional, or if you don't qualify, we have to refinance the FHA one out of FHA into conventional, and then you can use the FHA on the new home. That's a possible scenario for some people. Now, again, if we have to do that, that's because of this new purchase that we need to get out of this house as soon as possible to get into this bigger space for our family. At that point, we're not really considering what's going on with the market and rates and PMI and things like that. We kind of just have to get it done. But since that's not the case and we have some time, we're going to say, you know what, let's hold off on doing any refinance or touching that mortgage until conventional rates or just rates overall come down, and then we'll do a refinance for you. Again, like I explained earlier, to get out of all those things, right? We get a lower rate, get out of the PMI, and get out of FHA into conventional. Win, win, win. So that was the question. Now, again, buying the home in Vermont, do it as a second home, 10% down, as long as you can carry both payments. So the thing with a second home is if you're buying a vacation property that you're going to visit every now and then, you can do 10% down if you can carry that payment with your current mortgage payment. You can't rent it out. You can't say, well, I'm going to Airbnb it. Can I use some of that income? None of that income will count towards your qualifying debt to income ratios, right? It's strictly a second home. Now, if you can't qualify carrying that payment, the other option is to do it as an investment property. Now, an investment property, you can use the rental income for, but it also requires a higher down payment. So you can't do 10% down. You have to do a little bit more. And all of this is because of risk, right? So, and we've talked about this before, primary residence, least amount of risk, lowest down payments, lowest interest rates. Second home, a little bit more risk, right? Because it's not your primary residence, but you're also not relying on any rental income to make the payments, right? We've underwritten the file. You can qualify. You can afford paying your current mortgage and this second home property. We're not using any rental income. So it's just a little less risky than like a full investment. Now, a full investment is the most risky, right? You're using rental income to qualify, so you have to put more money down. And if one of those tenants doesn't make payments, or let's say none of those tenants for a month and you have to be able to cover it, your primary residence is going to be what you make sure is paid first, then maybe a second home and an investment property. If, excuse my French, shit hits the fan, the investment property you're going to let go first. Even the second home, right? If things get bad and you can't pay your bills, you're probably going to make sure the roof over your head is taken care of, right? That's the idea as far as risk goes with occupancy. So primary, lowest rates, lowest risk, lowest down payments. Second home, a little bit higher on everything, a little bit higher down payment, a little bit higher risk, a little bit higher rates. And investment property is the highest. Because again, you're relying on other people to help you pay that bill. So higher risk, higher down payments, higher interest rates. So if you can qualify, and this is, the advice of the client, we'll do the refinance when the time comes. You don't want to buy this house in Vermont until that's taken care of anyway. And he wants to see if rates come down and, he gets a better deal on that mortgage. So we'll do the refi when the time comes. Then right after that, we could even look at maybe taking out some equity, taking out some cash from the equity he has in his personal home to use towards that new purchase, right? And do it all in one shot. So now we're getting out of FHA, we're getting out of the PMI, we're getting out of the higher payment, and we're getting some cash out of it. So maybe we get the cash and then the payment stays the same as what you're paying now, but you got money from the equity to go put into the second home property, right? That's kind of, again, the strategy behind the planning and dealing with a professional and expert loan officer. These are the kind of conversations that we have and we plan out. Whereas again, someone might say, yeah, let's do the refinance right now, get you out of FHA, then try to hit you up again in a year, and every time they're collecting commissions on that. I just don't think that's really the ethical way to do it. Let's do it all in one shot when the time is right, and then we'll do that house in Vermont when we're ready. So if you can do it as a second home, 10% down and afford it, we're good to go. We're golden. And then, whatever you do on the back end, Airbnb it, rent it when you're not there, we don't want to know about it. Don't ask, don't tell, right? But, or if you can't afford it as a second home, you do it as a straight investment, and we can use rental income to help you qualify. And then again, what you do after that, rent it, don't rent it, Airbnb it, whatever you want to do, or just use it as a second home. But you have to come up with, more money. 20, if it's a multifamily you're buying up there, definitely more money, and that's definitely an investment. You can't do a multifamily second home. Second home is strictly a one-unit property, condo or single-family home that you're going to use for you and your family to visit every now and then, typically in some type of resort area on a beach, in the mountains, somewhere like that makes sense to have a second home. You can't say, oh, I want to buy the house next door down the block or in some city urban area as a second home in most cases. You could, if you lived in Florida, let's say you live in Florida, primary residence on the beach, right? That's just where you live. You have a single family home and you want to buy a second home in New York, a condo in the city. You could do that. It's not a resort area. It's not in the mountains or ski resort or on the beach, but you could say, well, I travel back and forth sometimes for work and I just want to have a place that I own out there. You could do a second home, 10% down, right? So just different ways to look at these things and consider them. So that was the scenario with that client. Hope that helped. And, we look forward to doing those deals for him when he's ready. And just that's the awesome part about owning real estate, right? You have all these options, and when the market's right or not right, and you're planning to get out of a current situation with a different loan product, or even tap into some equity to get some cash to go buy like a dream second home in Vermont where you go take your family, snowboarding and skiing. I mean, if that's not the American dream and goals, I don't know what is, right? So let's talk a little bit about the economy before we wrap up. Just an update. Haven't done this in a little while. So jobless claims are up higher than the consensus this week. And as we know, jobless claims are basically unemployment, right? If it's up, that means that the economy, inflation has made an impact on jobs and the unemployment rate. And unfortunately, the government does use that as a barometer of what's going on in the economy and when they should start cutting rates, or to see if what they're doing is working, right? So if they're raising rates, things are getting more expensive and businesses are laying people off and people are filing unemployment claims, that means what they're doing is working, unfortunately. So they look to that to see if they should keep raising rates, cutting rates, what's going on. So jobless claims are up higher. The consensus was 200,000 and the actual was 214,000. So that's a good sign for the Fed to say, okay, what we're doing is working. Now, what does that mean for what they'll do in the coming meetings? We'll see. The first Fed meeting of the year is this upcoming Wednesday, January 31st. So very big day, first of the year, as far as the Fed getting together and determining what they're going to do at rates. We're expecting them to hold at current levels, right? That's kind of the market expectation. Again, because unemployment is up higher than was expected, it's like, okay, then what we've been doing is working. We definitely don't need to raise rates because, unemployment's going up without us doing anything. So let's leave that alone. We're not sure if we need to cut rates yet either, right? So we're expecting that they just hold at current levels and kind of see how things continue to play out. we haven't seen the sort of economic data necessary to meet the conditions of a rate cut, right? They just haven't seen what they want to see to say, okay, things are getting a little too out of hand, or employment really spikes up, or core inflation is really really low or something, or that we need to start cutting rates, right? They're still working on getting inflation down, and these unemployment numbers are still going up. So it's kind of like, okay, let's hang out here for a little bit. We're comfortable where it is for now. So those economic indicators aren't where they need to be really yet to see cuts, which we weren't expecting. We're expecting it, probably towards the end of the year. Some reports even earlier. I've heard again as early as March, maybe May, somewhere in the summer, when these meetings happen every month and a half or so. So this isn't to say that it can't happen in 2024. Like we just said, it's probably going to happen as far as these rate cuts during this year, which is awesome. But just that we're saying that it's just a little too soon to debate it, or to see that happen soon because of these indicators. So at the very least, we know we haven't met the conditions to rate cut yet, but the Fed could surprise us at their meeting, right? They could say, I doubt they're going to say we're going to raise, but they could, in which case rates would probably jump up significantly. And if they do decide to cut, it would be a huge surprise, and the market would react in a good way, and rates would come down pretty significantly because the market has a feeling or an understanding before every meeting of what's probably going to happen. The pricing is already built into the rates. So the rates we have now are expecting them to hold. The only way they'll change or go lower is if they do something different than hold. But if they hold, it's going to be the same that it is now. So a couple weeks before every meeting, based on what the market thinks is going to happen, the changes are already started to be priced in as far as interest rates, mortgage rates, things that we're interested in, right? So we kind of know a little bit before. So sometimes we'll start to see rates trickling up or down whatever way before the Fed meeting, and that tells us, okay, the market sentiment, the market feels that they're going to cut, they're going to hold, they're going to raise, whatever that situation shows. So right now we just feel like they're going to hold, which is still good. Rates are decent now. I've been quoting rates in the sixes, low to mid sixes, for most scenarios with decent credit and assets, down payment, everything, debt to income ratio, all looks good. You definitely be in the sixes. So we're, I think if these rates do come down, they're going to be in the fives, and with points, definitely maybe low fives, maybe even high fours, which would be awesome. But remember, when that happens, the market's going to go crazy as far as the real estate market, right? There's going to be a lot more activity, a lot more people going to see these homes. I'm actually going to go pass by an open house tomorrow. One of my real estate partners, and just see what the frenzy is like, and then also a home that's in our local area that I just want to pass by and see what the demand is like, how many people show up. So that's just interesting to keep a pulse on the market. But if and when these rates come down, market demand is going to shoot up, and then prices are going to go up because there's going to be more people jumping in. Hopefully more houses come on the market, like we said, and like we continue to say, but that remains to be seen. So that's basically it for this week. Hope you all had a great week. We will see what this Fed meeting yields on Wednesday and talk about it on next week's pod. If you have any questions about anything we went over, definitely feel free to reach out, and we will give you all the links and all the information that we need. I didn't do it last week, but the outro: goal in life is to be mortgage free, control your emotions, have integrity. If you want to use my likeness, I need equity. And if you're really trying to win, you need to bet with me. Take care. Good to see you. We will talk soon.